Right. Don't know what I'm. Okay, so you can hear me. Okay. Sorry about that. Me and technology, probably all my fault. Okay, let's try and get my face in the camera. Okay, I guess I'll start. I guess you can all hear me. All good, right? Okay. Sorry about that. Typical me. Sorry, right. I'm just going to move this down here. Okay, so I've actually got Bitcoin on there. I don't particularly want to talk about Bitcoin. But clearly we're in a bear trend, and if you've been following me on FX Street, then you'll know that I remain pretty negative about Bitcoin. What I was going to start off with was the dollar. This is actually a really great time. I'm quite lucky to be hosting this today because I've just this weekend spotted some really important things, and I'd like to share them with you. And I'm going to be looking at long-term charts today. Really important stuff on the monthly and the yearly charts. And even if you're just a short-term trader and you're just trading hour to hour, maybe positions overnight, if you're a scalper, you know, and you only hold position for minutes, then you're probably not too bothered. But if you're a trader that may hold positions overnight, you probably want to be aware of a lot of this. So I'm actually going to go to the yearly chart down here. Let's try and blow this up a bit. There we go. I don't need that. Let's do that. I've got 4 different time frames on here. Okay, the yearly chart for the US dollar index. Now this is really interesting. I've got a peak up here in 1985. So this chart is going back nearly 40 years. And the low down here in 2008, that was the global financial crisis low. And that's when the dollar bottomed out and started to recover, something of a double bottom there, you could argue. Now, since then, of course, it doesn't look like the dollar's done particularly well over the last year when you compare it on this chart. It just looks like we've pushed a little higher, but the dollar has had a great run. The dollar index going up from 94, let's call it 94.65, up to 105.78. So we're talking about a good 10 points there. That's a lot for the dollar index this year. Nice big green candle. Now, the key point here is I've gone so far back, really try to capture the biggest move that we have in the US dollar, certainly on my data anyway. And we've got a 38.2% Fibonacci level at 106.61. This is, this was really important. This is the first time that we've tested this level, the first time we've come to this level. And so where do we get to? 105.79, I'm going to call it. That is within, if my math is correct, what's that? 80 pips of that 38.2% level. Now, 80 pips is nothing. It's the smallest of margin when you're looking at a 40-year-old chart. You can imagine that 80 pips really is absolutely nothing. So it really is very important, this area. It could be that the dollar has just completed the move. This is the high for this particular move. I'm not saying it won't break out later. We don't know what's going to happen fundamentally with the economy and interest rates and inflation and everything else. But right now, it certainly does look likely that the dollar has peaked, or at least you need to be aware of this very important level at 106.61 if you are a US dollar trader, especially in the long term. Now, we don't have any particular negative pattern on the daily chart yet. And of course, I'm not saying that just because we've got close to that level, I'm not saying that now the market's going to suddenly turn around and collapse and it's all over. We may need to trade sideways for a while through the summer. We may need to build a topping pattern, a head and shoulders, a double top, something like that before the market collapses. So I'm not saying, right, quick, if I were you, I'd sell the dollar immediately. By tomorrow, we're going to be 500 pips lower. But I'm just making you aware, it's a yearly chart. So this is a long thing. Now, the monthly chart, no particular negative candles on the monthly chart. Of course, we've only just started to pull back. Looking at the weekly chart, again, nothing too negative as far as candle formations go, although the weekly chart does kind of highlight that we are hitting this trend line, which goes back to 2018. So again, that sort of lends weight to the argument that we have perhaps, or we are going to form a top around this area. Slightly easing on the overbought levels. I think we'll probably trade sideways for a little bit. And what I would really like to see is another spike higher, maybe get up to 106.00. Then we get this big bearish engulfing candle on the daily chart, which is then matched with a big bearish engulfing candle on the weekly chart. Then I can say to you, right, we've got the negative signals. We've definitely tested the resistance level. now it's time, I think, to short the dollar. I don't think we're quite there yet, but I just wanted to make you aware that there is a strong chance that we will begin some sort of topping pattern in the dollar, which indicates to me perhaps that we might be entering a more of a risk on environment. Now, I can back that up. Let me back that up for you. So we have to look at the bond markets. I'm going to look at the 10-year T-note just because that's the one I tend to follow. I'm not a bond trader, so I don't really know if it's a sort of a benchmark that I should be looking at, but this is what I'm going to look at. Now, what was my point here? Oh yeah. So when you, again, looking at the yearly chart, we're getting close to, we haven't got there yet. We're approaching a very important fib levels in the yield chart. So 3.97% for the 10-year is a big 23.6% fib on this move. Now, you can see from the yearly chart, and I'm going to zoom in on the weekly chart because we need to see more detail. I've drew this line on the weekly chart, which is why it looks a slightly skew whiff on the yearly chart. But you can see we burst up through the resistance, burst up through the trend lines, and that really did, on the yearly chart at least, trigger quite a move to the upside. Going to the weekly chart. There we go, breaking up through the 23.6% fib, the trend lines, everything else, off we go. Quite nice, actually, when we broke through that 23.6% fib. We just dipped to it. Where did we get to? 2070, 2.7%, 2.65% was the Fibonacci level. So that acted as a nice little platform for any bulls to buy in, and off we go. Now, on the weekly chart, we have a slightly negative candle in that last week we probed up and then came down. We closed a little bit up on the week, but nowhere near the high, leaving that long upper wick, which does, of course, indicate that there was some significant selling pressure at some stage during the week, which pushed the prices back towards the open. We still managed to close up in terms of bond, in terms of interest rates. Where do we close? Opened at 317, closed at 323, 3.23. So we closed up 5 basis points on the week. We did manage to hold above the previous high, but on a closing basis at least, which was the week before. No, sorry, what am I talking about? The month before. That would have been May. May high looks like it was 3.20, and we managed to close last week at 3.23. So in that respect, it's a warning sign, I think, as far as 10-year yields are concerned. Look out, maybe we're running out of steam, but I wouldn't say that that's a sell indication, and I wouldn't be looking to buy the bonds just yet. Well, not the 10-year T-note anyway. So again, it's tying in with my sort of dollar theory that we're approaching a high for the dollar. Maybe we're getting to the stage where the markets are starting to think about taking on a little bit of risk, which would mean the dollar would fail, and of course that the market would be willing to buy some bonds. I don't know the fundamental reasons for that. Maybe the fact that the Fed has now decided to raise interest rates by 0.75%. The ECB has finally come around to the idea, way behind the curve, of realizing that they also need to fight inflation. Maybe the market's now thinking, okay, at last, the central banks are starting to get serious about inflation. So maybe 6 months, 9 months down the line, inflation will be more under control. We may be entering a recession sooner than we had thought, 2 weeks ago before the central banks got serious. And now the market is starting to think that maybe we can get into recession earlier, get out of recession earlier. I don't know. I'm not an economist, but I'm just trying to make sense of what I'm seeing on the chart on a fundamental basis. That's actually what I'm trying to do. I'm not thinking those fundamentals and then trying to see from the price action whether that backs up what I'm saying. But when we look at the US market, actually we're going to go to the DAX now. So as I say, the theory is possibly that the market's entering a more risk-on environment. If that is the case, then the one thing that will benefit is the stock markets. Of course, the dollar might sink and the bonds might recover, but bond prices might recover and bond yields might dip. But one thing's for sure, if there's going to be a risk-on environment, investors are going to be piling into stocks. So do I see a potential recovery in the stock markets? And actually I do already. Already we've tested some very important stock market levels, support levels, and we are bouncing off them. Now the DAX, I think I better go longer term here. The yearly chart will actually look more clear initially. So we had good support around the low 13,000 area, shall we say, on my actual, if you may have actually read my analysis. I'm sure I posted it on FX Street for the DAX last week. And I had 13,250, 13,150 as my big important support level. Now, we did overrun further than I expected by about 200 points. We got down to just below 12. Sorry, I don't need to be on the yearly chart because that's showing the low for the year. And the low for the year was made much earlier on. That was in March. So my big support level is around sort of 13,100, 13,250, 13,150 if you read the report on FX Street. We dipped as low as 12,950. So we did overrun further than I expected. But last week we did see a good recovery. This is the weekly chart now. We did see a good recovery. The last print for the week was at 13,193. So we certainly recovered to within the support zone. And of course, this week we're starting to push higher. The low this week, 13,035 so far. So perhaps we are building a little base. You can see the 200 week moving average, the red line there. We didn't close above it last week. So that gives some confidence to bulls that we're holding that support level and maybe we can recover. Daily chart, I don't think that actually gives us any further information. This chart's a bit messy. I'm not that comfortable with it, if I'm honest. The US charts are a lot clearer, but I just wanted to show you that even in the European markets, having said that, FTSE is probably clearer than the DAX in holding a good support level. Now, where did I get that good support level from? Here we go. Again, fibs, moving averages, not really any trend lines for me to rely on with this chart. Could I argue there's a trend line? Let's have a look. I don't know. Not sure if that is a trend line or not. I'll leave it on there. But you can see now, taking the fibs from the low of 2020, the COVID crash low for the FTSE. Now, FTSE managed to recover back up to the 2020 high. And this in itself is interesting. Okay, 2020 high, just before COVID broke and the world imploded, we got to 76.29 and a half. We've managed to get back up there, actually. I think it was this month we got to 76.45. We even tried to break above that 2020 high, but we couldn't do it. Now, all this year, really, we've been trying to break above that high. Look, we tried it in January, we got close. In February, we hit it, 76.29 and a half. Actually, that was bang on. And then in what month is this? This is April. We got to 76.35. You know, look, week after week, trying to break through, just not quite doing it. Every time we tested it, it was some of these red candles showing that the sellers really did come in, so much so that we closed down on the week. Now, there's a lot going on up here. Peak number one, I could actually call this peak number one, couldn't I really? 76.66, and that was in 2019. 2020, early 2020 in January, we approached the same level, 76.29, and then again this year, what did we get? 76.29, 76.35, 76.39. So I could call that a triple top. I could even call that a quadruple top, perhaps. Now, and again, if you read my FTSE report on FX Street, you would have I had it in capital letters. This could be a triple top. I didn't say it could be a quadruple top, but it could be, and that is enormously negative because it's a very rare pattern. And guess what? The market then plunged from 76 and change down to 69 and change. So getting on for 700 points very quickly. If any of you traded that, by the way, let me know. I'll be over the moon that you did. I didn't actually trade it myself, but I'm hoping someone was reading what I posted on FX Street and reacted to it. Now, we have hit my target and a very strong support level for the FTSE. Clearly, you can see 23.6% fib around 69.50. 200 week moving average, 69.12 looks like the exact value at the moment. Blue 100 week moving average just turning higher, and in a couple of weeks that will be crossing back above the 200 week moving average if we maintain that as a low, and eventually we'll get up through the 23.6% fib. But the point being, I think we actually 69.10. So it was actually the 200 week moving average that was the precise low for this move. But we certainly closed above we what am I looking at this week? This week we opened, we got down to 69.10 on the open, having opened just above. Sorry, let me start again. We opened, the first print was a 69.64, just above the 23.6% fib. We dipped down to the 200 week moving average and bounced off it. And of course, we've now seen a real good move off that level. So the support level has been brilliant. And again, ties in with my idea that stocks can recover. We're entering a more risk-on environment. Stocks seem to be getting ahead of themselves because I'm not sure if the dollar's actually peaked yet, but maybe the stock markets are telling us that the dollar will peak or is close to peaking, maybe has peaked. Same for the bonds. Maybe the stock markets are leading the way and we've already seen the peak to the dollar. Can't be sure. Okay, again, NASDAQ. Now, I don't think we need to look at the yearly chart for this one. We'll just go back to, where did I start my fibs? Probably started them at the global financial crisis crash low. I did. Let's look at the monthly chart then. That's a bit too much information on one chart, isn't it? Let's spread it out. By the way, if you've got any comments, questions, please interrupt me. I think I'll get a message box up here somewhere. There's my chat window. Yeah, okay. I don't think anyone's said anything to me yet, but I'll just kind of leave that over here just in case anyone does have questions. Okay, from the monthly chart, you can see that there is I've taken just a crash low from 2009. Would you believe the NASDAQ then was down at 1,040? Wow. And it went up to 16,700 in the space of, what's that, 12 years. Oof. Hope some of you own some stocks for that. Right. Now, we have collapsed in the NASDAQ. This is, one of the tech-heavy NASDAQ, or the tech index, has collapsed from 16,767 to a low of 11,036. So that's about 6,700 points, isn't it? A huge move to the downside. One of the hardest hit indices. The 38.2% fib when you take the low from 2009 at 1,040 and project it up to the high for last year. Last year was the actual peak, wasn't it? It was in December, or was it even in November? Anyway, before the market turned. Now, we get 10,760. In my report, I put 10,800 down to 10,700. Surely some of you must have read that on FX Street. I know I've posted that report a couple of times. Where did we get to? 11,036. So we got to within, I'm going to call it 200 points or so, 250 points of the big support level. And we're bouncing off it so far. Doesn't mean we won't turn around and go back and retest it and then go again. But for now, we've definitely bounced off it. 50-month moving average, that's the black line. That comes in at 10,590, but it's climbing. So if we were just to hover sideways for a little bit and then turn down maybe in the beginning of August, we would maybe touch the 50-month moving average and that Fibonacci level. So watch carefully. Do we have anything on the daily chart to suggest that the low is already in? Not really as far as patterns and candles go. In fact, this is almost a bearish engulfing candle that we had when we touched that low of 11,036. So again, this kind of ties in. If we had something bullish on the daily chart or even on the 4-hour chart, we don't even have that. I don't think we've even got like a massively negative candle on the 4-hour chart, which is over here. Shall I just expand that to make sure what I tell you is correct? Why don't I? Okay, yeah, even here we don't have anything that's particularly bullish, and no short-term pattern yet. So I don't want to jump the gun and say, hey, the NASDAQ's definitely bottomed out. 11,036 is the crash low, and we're going to continue higher. Just be cautious. If you think there's any merit in what I'm saying and you're interested in a long position, what I'm saying is don't do your full size yet. Maybe 25%. Just then you've got your interest, and it'll focus your attention on the market. But I wouldn't be putting full size on right now. It's too risky. We're not even severely oversold, and we are oversold. But we haven't been oversold for a while. Look, the market can stay oversold for a significant period of time. We could drop 500, 600, 700 points from here. And anyway, okay, look. The other thing I'm going to say is Dow Jones. Now, this did actually touch the support level. So it's quite interesting because the S&P's, the Dow Jones has been the stronger of the three markets that I follow, Dow, NASDAQ, S&P. NASDAQ's the weakest. S&P's been caught in the middle. Now, I think we do have something of a bullish candle this week, actually. It's 29. That's interesting. This week's low is exactly the same as the low from 2 weeks ago, which is 29,741. I'm only just seeing that for the first time. I didn't realize. So I could argue that we have a very small double bottom on the hourly chart, probably, could I? Yeah, it's a tiny one, but at least it's a double bottom on the hourly chart. Now, where did I get my support level from? Well, you probably guessed it's from some Fibonacci levels, which go back to 2009, exactly like the NASDAQ. The 23.6% fib is at 29,664. What was the last week's low for the E-mini Dow Jones? 29,741. What's that? 80 pips, 80 points. I mean, it's just nothing, is it? Especially when you're going back 12 years or even 13 years on this chart. So as far as I'm concerned, we kissed that level and we're starting to bounce off it. Only starting. I say that we're 500 points or so above it. Now, what's the high for this candle here? 29,362. So that lends some extra weight to that. 29,543. So you can see the peaks here at the beginning of 2020 tie in really nicely with that fib level, giving me extra confidence that it is a significant support level. Price action definitely backing up that there, and even these little dips here, which obviously held the previous peak. So there we go. Again, all this is evidence backing up my theory that we could be entering a risk-on period over the summer. Maybe we've had enough of a collapse for the first 6 months of the year. Now, the only thing that doesn't match up is the S&P. You know, when you're doing technical analysis, you're really just trying to get pieces of a puzzle, put it all together, you know, and try and make an educated guess. That's all you can really do. And I think if you show the same set of charts to 5 different people, they'll all come out with a different idea. There's no, you know, this is an art, not a science. This is my interpretation of it anyway. Now, the E-mini S&P, again, taking the Fibonacci levels from the 2009 low, we've broken the 23.6% fib at 38.30. That was my sell signal. Again, you'll know that if you've been following me on my post on FX Street. I called a low initially when we first tested that area, and I got lucky on that call because we bounced right off the support level, 38.07, bang in the middle of 38.30 and 38.02. Nice run back up to the 23.6% fib. Look how well these longer term fib levels work. We bounced off this area straight up to 41.86. What was the high? 41.89. And then we just turned around and sank. Now we've broken lower. So, you know, if I was looking at the E-mini S&P chart alone, I would be feeling very, very negative. I would definitely be short, and I would be looking to sell on any bounce up to 38.00, 38.30. But then when you look at everything else, it's indicating to me that maybe I shouldn't be short the S&P. But I just wanted to show you that not all the charts, certainly not all the US charts, are indicating that the market's about to turn around and roar up. I don't see anything bullish in that myself. Anyway, let's just have a look at the weekly chart. In case there's a candle that I missed, but there isn't. Big red candle last week, closed near the low of the week, which would normally indicate further weakness, you know, on the open, maybe even a gap lower on the open, but that didn't happen, and we are recovering, and I think that's all due to the fact we've got those other markets that I showed you are indicating strength. Now, what else do I want to show you? Oh yeah, euro. Probably should have shown you this when I showed you the dollar index chart. But there are some currencies that are backing up my theory that the dollar's weakened. The euro happens to be one of them. And it's good that the euro happens to be one of them, because if I remember correctly, the euro has the biggest weighting in the dollar index. So you would want to see something from the euro US dollar chart that backs up your theory, backs up my theory anyway. And let's go back to the lovely yearly chart, which seems to be so important at the moment. 60, right, again, let me give you some parameters. 1985, now that was the low, that was the peak for the US dollar that I showed you on the dollar index chart. I'm not quite sure how we get this. This must be adjusted in some way, because of course the euro didn't exist in its current form at that time. But anyway, I'm just going to take what I see on the chart. If any of you know I wasn't on the stock exchange floor in 1985. Here's where I got in 1987. That's when my career started. Okay. I can't remember that far back as to what I remember. There was an ECU, which was, I think, the beginning of the euro. Anyway, whatever. Right, 61.8% fib, going back to 1985 and joining the peak up here. Oh, hang on, someone's asking me a question. I don't want to miss it. What's the importance of long-term analysis? Okay, great question. I'm glad you asked me that. Well, I'm trying to actually show you today, because if you didn't know, if you didn't go back to 1985 and you're just focused on your daily chart and you're just looking back sort of the last 6 months, you'd be looking at a very positive chart for the dollar, very positive. Let me go back actually, because let me just show you how important it is. Great question. So if I go to the weekly chart, I'm happily trading away the dollar. I've been long. I'm doing really well. I'm following the trend. I'm buying it when it dips down to support. So for example, fib retracements, the last big move, we got to the peak up here. Okay. Now, you may not even be looking at weekly charts. So if you're not, you definitely need to be doing that, because you would have missed the low for the dollar on this pullback. Yeah, just the fibs alone would have told you, right, we take this little low here down from May 21. We take the last move up. I'm just going to show you that's a little swing move. Look, you can see this is where the last leg higher started. So I'm just taking my fibs from there. Very short term. We're only going back a year. It's been a year bull run. Really nice. That we found support right on the first 23.6% fib level. Bang on. 101.35. What was the low? 101.29, 101.29, bang on, that 23.6% fib. So if you're trading like this, there's also some nice little trend lines there that are backing up that area. These trend lines go back quite a bit. This one goes back to the beginning of 2018. So we've got a couple of trend lines. We've got the Fibonacci level, and you know that indicated that the dollar would probably bottom out, and it did get a bit of a green candle, and off we go. So my point being this: if you were trading the dollar last week and you were just looking only at the weekly chart, you would have seen us break above the previous high back in May of 105.00. You'd thought, right, we're in a bull market, buy on a break above the previous high. That's what you're supposed to do. You buy into support, you buy in on a break above the previous high. You'd have been happy. We'd have gone up to 105.78. You're already looking at probably 70 pips in the bin. And then we suddenly reversed and turn around. You're thinking, why did we do that? Why are we now trading below the May high? That doesn't make sense. We shouldn't be doing that. You know, that hasn't happened that often when you go back over previous moves. You know, we beat the for example, the August high, and then September, through September, we did dip a little bit, but we recovered very quickly in October. Anyway, you see what I mean? You know, these dips shouldn't be too severe. So why we got this almost a doji, and you wouldn't know why we're hitting strong resistance unless you looked for that trend line that I drew and you looked at that yearly, really the yearly chart. Even the monthly chart doesn't really encompass it, because you just wouldn't have had enough data on the monthly chart. Even if you're scrunching it up, you're probably going to take a low from around here. Oh, sorry, that is actually the 2008 low. So if you did really scrunch up your monthly chart, you would have got the data. So that's good, but you wouldn't have got it on the weekly chart. Anyway, I showed you on the yearly chart just so I could have some clear candles on there to show you. Oh no, the reason I showed you on the weekly chart was because that was, on the yearly chart, because that's the only way you'd have seen the 38.2% fib. Okay, that's why I showed you on the yearly chart. So this is why you sometimes have to really go very, very, very far back to know why the dollar is just starting to show some signs of weakness, particularly with that doji on the weekly chart. Why did we not get a big green candle when we broke above the May high? This could be the reason. Does that make sense, Raha? Does that sort of answer your question? You wouldn't be aware of these longer term levels if you hadn't gone so far back. And you know, it's not always important to do so. Most of the time, I look at yearly charts. I try to remember to look at yearly charts and monthly charts. Well, at least once a month, obviously. And most of the time, there's nothing there because you know we're way away from some of the big levels. It just happens to be lucky that I've got you this week, just at a time when we are tuning in to some real big longer term levels. We have moved so much that they are becoming important now. What was I going to show you? I hope that answers the question. If I haven't, it does. Okay, great. Please, anyone else, if you've got a question, let me know. So just glance at them. If you're doing your technicals, and especially like, you know, a lot of people do it over the weekend when they've got some time before Monday, they figure out their game plan for the week if they're sort of swing traders and they're not just scalpers. Remember, just think, oh, I'm just going to look at that monthly chart. Make sure there isn't some trend line going back 5 years that I need to know about, or a Fibonacci level that goes back, you know, 12 years that I really need to be aware of, that we're getting close to. It's worth it. Or a moving average. It could be, you know, the market could have gone so far that we're hitting some 500-month moving average. You really need to know about that. because the big traders, the funds and the banks who maybe are also trading technically, they're not interested in the daily chart, the hourly chart, the 4-hour chart. They're really not. The kind of money that they're moving probably takes days, weeks, and maybe even months to deploy, or when they're getting out of a position, they're not going to do it in a 24-hour period. So these guys, I would imagine, I don't know, I haven't worked in that environment, but if they're technical traders, I would guess they are looking at these longer term charts and saying, hey guys, if we start buying the dollar, where's our target? Okay, well, over the next few weeks and months in their monthly meetings, they're saying, we think the dollar can get here. I would imagine they must be using these kind of techniques to identify these kind of levels. And if they are, this is maybe an indication that some of the big players are now just starting to exit long positions because they're aware that we are approaching this big level. And if that's what they're doing, you really need to be aware of it. The last thing you want to be doing is buying when they're selling, and then suddenly the market cracks to the downside, and you've got no idea why the dollar's going down because you've not gone far back enough to see the data. Okay, I think I've made my point. I hope I have, but it is really very important, and I'm just, as I say, I'm just lucky that at this time there are so many important levels on those longer term charts. What was I going to show you now? Oh, another thing that's kind of backing up what I'm thinking as well in terms of more risk on is that the oil price has turned around. Now, I'd love to call this a double top, but I can't really. In fact, I'm going to take these lines off. They're just distracting. There we go. But yeah, there's no particular oil pattern. If you follow my oil report, by the way, I did say a few days ago, where was it? I think, oh yes, it was just after this bearish engulfing candle. Look out below, oil probably. No, I think it was just before that. And then the bearish engulfing candle confirmed what I just had a feeling for it. It wasn't anything I could actually pinpoint. But the bearish engulfing candle came in on oil, and then of course we've sunk. Now, the weekly chart, if you read my report today, has a huge bearish engulfing candle on the oil chart. Look, we've taken out 3 weeks of pricing. We a new high last week at 123.68. We've collapsed. This is still the July contract, by the way. A huge bearish engulfing candle for oil. So it looks like a very big bull trap. All the longs from the last week, 3 weeks, are starting to look at, are staring at losses, or most of them. This really is quite negative. It would have been lovely if it was a bit closer to the previous peaks. I could have said, oh, double top, bearish engulfing candle, really doesn't look good. Look out below. But I think that this is enough of a signal that the energy price has peaked. Now, we have got a good support level, at least in the July contract, down at 104.50. We've got 105.00, 104.50, I'm going to call it. We've got the 100-day moving average. We've got the 23.6% fib. Whether we get there, I don't know. At the moment, we're holding the 50-day moving average in the July contract and seeing a nice bounce off there. But maybe eventually oil can get down to at least 104.5, and then we'll see what happens. If this is the beginning of a decline, maybe demand for oil is dropping off a little bit as inflation bites and people are spending less, and maybe the energy price will start to dip. I don't want to go on about the fundamentals. I don't really examine them closely enough, but it could be the case. Now, anyway, the point being, there are some negative indicators on the daily and the weekly chart for oil, and if oil continues to sink, obviously that would help inflation in probably not next month, but maybe in 2-3 months. It would help inflation to ease a little bit, and of course that might help the Fed. Maybe it'll help confidence in the market, won't it? Maybe the Fed won't have to be, or central banks won't have to be quite so aggressive. Maybe that recession will come a little bit quicker and be over a little bit quicker. So again, that's another little indication that the markets could be moving into a more risk-on environment as we begin the summer. That is it. Gold actually isn't doing anything at all, so it's not helping me out with an opinion either way. I mean, actually, I've given up trying to read gold all over the place. I think we go down because we do have a huge double top up here. Huge double top. The peak in 2020 was 2072. The peak in 2022 was 2069, 2070. So that when you look at it, let's have a look at it. It's on the monthly chart. That really does look like one heck of a double top pattern. So maybe longer term gold has peaked and will start to drift lower, but it will, considering it's such a big pattern on long term charts, that isn't something that's going to react quickly. Okay, my opinion on GBP. I'll be honest with you, I don't have a strong opinion on it, but I'm going to look at it in the context of me wondering if the dollar has bottomed. I'm going to look at the monthly chart. Sorry, in context of the dollar maybe has peaked. Now, look, I've struggled with cable for a long time. When you look at the monthly chart, that's just one big sideways trend. We didn't even get that close to the previous lows where we got these lovely big long wicks on the monthly chart, showing how the buyers piled in, and then the markets recovered very nicely for a year and a half and very nicely for a year here after that. So I just can't really give you a really clear opinion. You know, sometimes I just don't know, and this just isn't really giving me enough signals. Okay, something of a bullish candle on the weekly chart with this sort of hammer. Long lower wick does show that the buyers came in last week, and it is being sustained this week. Can we get up through? And actually, I need to really draw my fibs from up here. Let's get an idea of the fibs. Whoops, fib. Here we go. Yeah, I think I'm actually going to take that off. Should I take that off? Look, I'm not going to dwell on it. I can't really give you a strong opinion about cable. It probably will bounce. At least we've got something of a bullish candle on the weekly chart last week. We don't have any bullish patterns here particularly. We are in a bear trend. I wish I could say more. Sometimes I just don't know. So there's no point in me trying to pretend I do when I don't. There's just nothing concrete, nothing strong enough there. You know, at least on the euro US dollar, I do have a double bottom to play with, but not here. Maybe that's the wrong terminology. Thinking about what I just said there. Okay, dollar yen, someone's asked me. We've broken higher. We have broken higher. Now, this actually is quite a bullish chart because, again, I have to go back to the monthly chart. Do I? Yeah, I do. I do have to go back to the monthly chart. Okay, now look, this is the monthly chart. This takes a move. This is the peak of in 1976. Is it 1975? Wow. So I've taken that peak and I've projected it down because I couldn't really take this peak. I don't think there's enough data there. So I think this is reliable. I'm not really sure because this is as far back as my data goes. But anyway, if it is, then we've beaten the 23.6% fib at 130.30. Now, as I zoom in on it, anyway, the most important point is that on the monthly chart, we've got a big green candle. On the weekly chart, we've got a big green candle. And we're pushing higher. So this really does look quite positive for the dollar versus the yen. So this is more yen weakness, I think, than dollar strength. But it does indicate that the yen can continue to sink. Let's have a quick look at the euro yen just to see if I'm missing anything there. Well, we're going back up to the previous high. So of course, it's a question of whether do we get a double top around 144.23 or whether we break up through it just like the dollar has done against the yen and push up. New Zealand dollar versus the yen. I think I've got 5 minutes. That's not showing much. The New Zealand dollar versus the yen. The Aussie versus the yen. Again, not too much. But we clearly are in a bull trend. We clearly are holding some support levels around trend lines, moving averages, and fib levels. So at the moment, the yen definitely remains in a bear trend. Okay, does that answer your question for the US dollar versus the yen, dollar yen? I mean, clearly we're just breaking up, and it looks like we have broken resistance levels. I personally wouldn't be short, put it that way. The yen continues to weaken and it is a really strong trend. Actually, you know what I'm going to do? I've got so many fib levels on there, and I will take them off. So they're out of date now. Take them off, and whoops, going on there. Take them off, and then put the weekly chart up there. That just shows you what a trend it is. I'm wondering. When I saw this and the market turned, look, this is a bearish engulfing candle here back in the middle of May, and we'd gone so parabolic. When I saw this bearish engulfing candle, I thought, wow, on the weekly chart, this is important. That's it. Maybe the yen is now going to start to recover. I thought it's one of those parabolic moves where it just goes crazy, takes all the shorts out, and then you crash in an almost upside down V shape. But it hasn't. And this really just gives you some perspective on how swift, how brutal that up move has been for the dollar versus the yen. And yeah, I really don't see any signal that it's going to reverse at the moment. It does look like this trend will continue. Well-established trend now, miles away from the moving averages. Okay, I think we've only got 2 minutes left. So if anyone's got any question, fire them at me. It doesn't have to be about technicals. It can be about, I'll try and answer something on the economy, on the fundamentals, or if you've got a question about trading, let me know. If not, then I'm just going to see if I can give myself a quick plug here. Actually, let me see. Well, I'm going to try and get my website up there, but yeah, let me try and do that. Can I do that? That's my emails. Don't want to show them. Okay, let me try and show you my website, which is here it comes, daytradeideas.co.uk. Anyway, so if you like what I do actually provide a daily analysis and trade ideas, that kind of thing. Have a look anyway. Oh, if you want to have a chat with me, if you like what I do and you want to have a chat with me, look, free mentor session. Go to my website, click on that. It'll bring up a calendar. You can book a chat with me, and it would be nice to meet you. You can ask me questions. Let's see if I can help you with your trading, with your analysis. If you're interested in any of the products we have, of course, I would love to talk to you about that. But you don't have to be interested in a subscription to talk to me. And then we've got online courses and everything else. And if you're interested in daily analysis and signals that I do provide, just have a look up here on this page, and you'll see what products we do. And as I say, you can always chat to me about that. I've got a blog. I've just started doing a blog. And I've written something today. I just posted it before I came on to this webinar about why I think crypto will not recover, why crypto prices will probably never recover. So you might want to have a look at that if you're interested in crypto. Okay, I think we're coming up to the last minute. I hope that has been helpful. I hope you've enjoyed it. I do like doing these things once a month. And no questions from anyone. Okay, I think that's it then. We're getting to 13. We're getting to 10 to the hour, which I believe is the end of the session. Haven't got enough time to go into anything else right now. Oh, YouTube channel. Loads of free stuff on my YouTube channel. Maybe I can show you that. Okay, I think we're done. My YouTube channel is YouTube. Whoops, turn that off. Thanks, guys. Enjoyed it. See you next month.